Hello everybody, this is Shankar from Emini Futures Trading, and our service has been operational and available to all S&P 500 Emini Futures traders since 2015, and it has been getting better with time, and of course the markets have been good as well. So as we record this on 22nd November 2017, the index has hit 2600 and the futures also are on track to hit 2600 and test that level in the next couple of days again. So in terms of background, I've been trading the S&P 500 in various formats since year 2000. Initially it was the S&P 500 index ETF, or SPY as we call it, and the index funds from various mutual funds. And then we had the leveraged ETFs, 2x, 3x leverage, which got me going towards the futures in a bigger way. And the real start to the futures trading career happened in 2009 after seeing the huge correction and really low valuations on the index and in general the whole market in 2008, and all the study that I had been doing till then was telling me that such sharp corrections and low valuations will give a bounce back, and targets of 1100 to 1300 were inevitable from the lower levels. So a very good gain was to be made if we had the capital to make that investment and take that trade at that time. In my experience, the E-mini futures trading has been really profitable, far more profitable than any of the stock trading or leveraged ETF trading that I have done. And it just comes down to the index, which is built with highest quality companies, and then adding leverage on top of that. So it's just the ideal futures instrument anywhere in the world. It's best in the world. And this service by eminifutures-trading.biz was aimed for other traders worldwide to trade with our service and make gains for themselves. So while I am doing the analysis and the market study and doing trades on my own, and there are some managed trading accounts, the same homework, same analysis is available to other traders worldwide through this service. Here's a chart of the S&P 500 index in December 2008, which really was the year where everything melted down. And the year started off at a high point in Jan, and right then it became volatile. And in the second half of the year, just around June, July, when people thought that things were stabilizing around 1300 level, we had the Bear Stearns, Lehman Brothers collapse, completely cracked the markets and took confidence away. And in my own experience that time and the notes I made for myself and my investors, I never thought Lehman Brothers would go down. I had consulted with them, and it's such a large historic organization with so many links and roots in the entire global financial system to just go down, completely unimaginable. And it happened. And the kind of fall that we had after that was really rattling, and we had no credit and capital available from any source. And that was a difficult point where prices are low. History tells us that we can get a bounce back, but where do we get the capital for buying those futures at that point? And even then, the volatility was so high that we had to buy a small amount of futures and somehow hold them for the inevitable pullback towards 1100 to 1300, which was what my analysis was. So that was a point where in December 2008 where I was confident that the signals given by the index were getting bullish, and one would not lose if one was to buy at 900 level with a 1 to 2 year time frame. And it turned out that way later. These are very extreme situations, and we generally get much more benign and safe environments to trade on a month-to-month basis, and stop losses generally don't get hit, or even if they get hit, we get a chance to come back and make our money back. It's not these waterfall kind of years that we get often, but when we do get them, we need to take extraordinary steps. We need to borrow from friends, relatives, credit cards, whatever it takes to buy when everybody has lost out. And there will be situations like this again in the future. Markets keep moving up and down. It looks very far away today at 2600 that we were there at 900, 800 levels not long back. So let's hope that we keep going higher, but when we get the correction, we make the most out of it. In the beginning, my trading career in year 2000, I was trading in a variety of stocks, ETFs, mutual funds, and other various assets, some commodity-linked options also were there. Tried everything, but it took me a while to get down to S&P 500. Every time I was making a loss elsewhere, it was the S&P 500 investments in ETFs or the leveraged ETFs or mutual funds that was always pulling me out of whatever loss I was making elsewhere. And it took me a while to, a few years in fact, to realize that I don't need those individual instruments and stocks and other funds when S&P 500 is the ideal product in itself. This is an index of 500 best companies from diversified industries having global operations. Nearly 40% of the sales and income of the S&P 500 index today comes from global operations. You can have companies like Microsoft, Google, Apple. These are completely global. In fact, and manufacturing, software development is global, sales are global, and even the pharmaceutical companies that are listed in the S&P 500 are completely global in terms of their sales and R&D. So manufacturing itself is now significantly distributed worldwide. So we have an index which is sitting in the US, but literally based on the global economy and global market and global users, consumers, as diversified as we can get, and its value is constantly increasing in terms of book value and earnings, because we have some of the best people working in these companies, and when we have an aggregation of high quality companies working together in an index, that index will keep rising in value over time. That's a given. So the index is designed to go up, and therefore it is one of the ideal instruments to trade, and the diversification offers enormous safety on the investments and trades that we do on the long side. So the S&P 500 has been evolving, if you observe carefully, with increasing weightage to growth industries like internet, software, biotech. These carry higher valuations compared to the older economy companies like cement, steel, logistics, transportation, and materials or related companies. That's because I think the market is seeing that the growth is in these industries like internet and software and life sciences, and that's where majority of the innovation in this century is going to come from in the coming years. So valuations are high, and that S&P 500 has been getting more and more weightage on that front. So it's evolving in the direction of the in the direction of where the economy and markets are heading in this century in terms of investor interest. So the long trade is a default trade on this S&P 500 index, and we need to be long most of the time. And that's how I have gained most of the profits. It's very difficult to get the short trade because it happens very fast. But we need to take action whenever there is a large fall, because after every large fall, there will be a rebound. And after some time, there will eventually be newer highs that will come. That's how the index is designed. So we need to worry about whether we are on the long side at the right time or not. Here's the long-term chart of S&P 500 index. It's of the last 37 years from 1980 to 2017 now. And you can see that the index has been moving up gradually in the beginning, but in percentage terms it was very good moves even then. And if you can see in 1987, there is that crash of 87 there, which looks so small today in this large chart. But it was a very big event then, and a lot of capital was lost when it happened. But then it took a couple of years for the market to revive and again get back. So when we have large falls, we have to somehow get the capital to get back our positions which would have been broken during the fall and hold them with some suitable wide stop loss. The trend that I have observed as a useful trend is to put a 50-month moving average like in this chart, and that is a good indicator for market movement. And as long as we are above the 50-month moving average, I think the market is in safe position. It rarely breaks that, and whenever it breaks that, it tends to go a lot lower from there. And the one case where I think in 2012 it came back up and then broke it for a month, rapidly bounced back. That told us that that was just another panic test, and it has been successfully done, and markets never looked back from then onwards. So based on this chart, there is another test of this 50-month moving average not far from where we are, because markets haven't tested that support line for a while. There was an almost near test in 2015-16, but the gradient of the rise has been very steep, and hence past charts indicate that there will be an attempt to test that support level again, which in a year from now would be near 2250 or 2300. So 2300 is a very possible target on the lower side in 2018 during some correction or the other. So we'll watch out for that. And if it holds that and markets bounce off from that level, then we can be sure of another 200 points up on a fresh long trade. And we can take that as 20, 25, 30 points per month. There are two basic trading strategies that we will cover in this slide. Depending on the state of the market, whether it's moving up, down, or sideways, we can define that market as trending or range bound. And for this particular analysis of the direction, we will use daily charts because that is very useful in trading on a monthly basis. So while the market may be looking as sideways or range bound on daily charts, the monthly charts may be trending up, as we have seen in our case in this year. There were many periods where markets were flat. For some days, it looked like a range bound market, but on the larger trend on weekly, monthly basis, the market is moving up. But we have to analyze at certain level of time frame and repeat that. So we use daily charts for this analysis. And so we have a trending market which would be moving up, for example, and you would have green days one after the other without any large corrections, and 50-point moves are common in a trending market. So for example, if 2400 has been broken successfully on the upside, then 2450 is a very real next target, and it can come sometimes in as less as 1 week. So sometimes even less, even 48 hours. Sometimes 30 points, 40 points in a trending market come within 2 days. So as soon as we identify a trending market, we need the buying action to happen ASAP, and then the patience to hold that position till the target is hit. And a suitable target in a trending market is easily 20 points on a single trade, if you can get that, buying at the right time. And if we have multiple contracts, like 10, 20 contracts or maybe more, then once we have done the buying, we need to release some of those futures periodically with profit and take those profits in the trending market. Every 10, 20 points, we can sell more futures, keeping in mind that a trending market will move 40 to 50 points in total. So by the time we have got 50 points in total, we could release all our futures. In a range-bound market or a sideways or consolidating market, the strategy is different, because this market will be moving up and down and hitting a resistance and then coming down from there, and then again taking support at a lower level and bouncing back from there. And this is quite common. We will have certain periods of range-bound market almost every month, and sometimes an entire month is a range-bound market. So it's important to identify what those support and resistance levels are, and as soon as we get that band analysis correct, then it's a very profitable month, because we can trade up and down and make 10 to 20 points on each of those moves, and it can be profitable, especially if we have the ability to buy multiple contracts, because we will never be sure about the buying if we have 1 or 2 contracts only. But if we have the ability to buy 5, 10, 20 contracts, then we can stagger the buying at various levels and release them at upper levels, and again refill the contracts at lower levels. But range-bound markets are profitable for trading. They are not profitable for investors who are holding those mutual funds or stocks, but very profitable for trading. And I actually quite enjoy range-bound markets very much, because of the reliability they offer in terms of not running away on either side. Here's a daily chart of S&P 500 for the current year. It starts from October 2016 to November 2017. So before the U.S. election of November 2016, when Trump got elected, and we had a lot of jitteriness in the market and a big down move on the election results, and then again a quick bounce back from there, and then not looking back. If we use a 50-day moving average, which I often use for analyzing daily charts, that line is plotted on this chart, and you can see it's a nice trend line for the market. It goes up, and once it has gone sufficiently far away, which could be something like 50 to maybe 80 points away, never more than 100 points away in my view so far. Say 50 to 80 points, max 100 points. That's the time when it has gone too far, and it now consolidates and stalls, and tries to retest that line as it moves up, and sometimes breaks it a bit, goes down a bit, but in the whole of last year it has never really broken that. Each time it went below the support line of 50-day moving average, took a few days there, maybe sometimes just a couple of days, bounces back again. That confirms to us that the larger trend for the year is intact, and we can keep while keeping our stop losses, of course. And we had a series of tests of this line mid of the year, and then again the market has taken off in the last 2-3 months, hasn't come back to the 50-day moving average since September, which also tells me that maybe there's a retest of that waiting in December before we close the year. And if we don't test this line in December, then it is a high probability that we will test it in Jan, because that line needs to get tested often for the trend to remain healthy. Here's a next slide on targets and stop losses. Many of the questions that we get by email or in our telecons with investors and traders who are looking for any kind of guidance on E-mini futures trading revolve around targets and stop losses. So I thought we'll put a slide on that in this video. We will cover this topic in much more detail in a subsequent video, because this is an important topic and one slide won't be sufficient for all the knowledge that I would like to share on this topic. But this is the key points here, that in my experience, approximately 1% of the S&P 500 index, which is about 25 points today, but not long back it was 20 points, and that 20 to 25 points is a suitable target for reliable and repeatable gains every month. So 1% of the index is what we want to target as gains every month, and that much is there. And the 20-point guarantee that we have as performance guarantee for our service per month originates from this point. And we will keep it at 20 because markets keep moving up and down, and 20 points a month is already very good if we can keep making that month after month. And with 10x leverage of futures, a 1% gain on index means 10% gain on that trading capital. And I think our futures are currently at even better than 10x leverage. So with most brokers, so we have a more than 10% gain on our trading capital per month that we are giving as performance guarantee, which is very unique based on my understanding. It's not available with anybody who is providing any form of trading service. And that was the goal of starting this website and the service in the first place. In terms of stop losses, first of all, we have to be ready to get hit with stop losses, because markets cannot be predicted or analyzed completely. That is our limitation. And whatever we may analyze, there may be a counter move to that, and which will create in a stop loss. So result in a stop loss. So we have to be ready for stop losses, and there are months where we have multiple stop losses, but we somehow manage to recover all of that loss in a good trade which follows from those stop losses. 8 to 10 point stop losses are the minimum in almost every trade, and anything less than that is just donation to the market, and we are putting our futures on a plate for somebody else to take away. I don't think that's a good way to trade. And in terms of target, we can target 10 to 20 points per trade, very much possible if the setup is chosen correctly. If the market is trending up, we can aim for the entire 20 points in a single trade, and we should aim for that actually. And if it's a sideways market, then we can't aim for 20 points, because there will be that choppiness which will come in, and the gains will go away. So in the sideways market, consolidating market, we'll aim for 10 points per trade, with a typical 10-point stop loss behind it, or maybe less if 8 points if we are buying slightly higher. But if we are buying in a consolidating market, range-bound market, if you're buying near the lower end, then you can even go for a 5 to 8 point stop loss, because that ideally should not break. But it should be around 8 to 10 points for the trade to remain safe. Otherwise, we would just waste a stop loss and instead of getting a target. We will cover these points in more detail in a subsequent video. We will have a series of videos over the next few weeks and months. This was the first of the videos, and this is a topic which is important as well. Here's a slide on long-term trading success, which shares some of my learnings over the last few years of trading the E-mini futures and getting decent profit out of them. In fact, the kind of profit that I have seen from E-mini futures trading has been better and far superior to any other trading profits and investment profits I have seen from other investments. And I'm also in touch with a variety of other investors who do various forms of investments in commodities, real estate, currency, and in my view, the kind of reliable and repeatable trading gains that we can make trading the E-mini futures is far superior to any other instrument because of the underlying structure of 500 good quality companies working to constantly increase the value of this index. That makes the index really, really good for long-term trading success. And we just need 20 points a month to produce 100% ROI on our trading capital. And the futures are so stable that we can increase our allocation with time. And ideally, a lot of our capital or significant part of our capital can be used for trading E-mini futures. And we just need 2 or 3 good trades per month for long-term success. And they are available almost every month. Whether it's a trending market or a sideways market, we will find that there are 2 or 3 good trades that we can take. Sometimes the analysis goes wrong and we get stop losses, so we will have to do a few more trades to get back into profit zone, in which case we may end up doing 5, 6, 7 or 8 trades that month to come back into profit. And there are several months where we just take one trade and that hits the target and we've already made 20 or 25 points, and that's good for the month, and we can just observe the market from there onwards. Volatile markets need to be handled carefully. Volatile markets need smaller positions to be carried through till the target with a wider stop loss, rather than large positions getting hit with a tight stop loss. So the point here is that volatile markets need smaller positions with a wider stop loss so that we don't get hit in the stop loss and we are able to carry through our position to its target. Very similar to what I have mentioned earlier in the video for 2008 December. So when markets are volatile and we think that we have got our analysis correct, we just need slightly smaller positions than normal, and we need to hold and wait patiently for the targets to come, which they will come inevitably. The problem with some of the trading strategies and traders, including myself in the past, is the positions were very large and they all got hit with stop losses. So we actually end up a loss rather than a profit. So volatile markets need to be handled cautiously. And when markets are stable and not volatile, we can have larger position sizes, but with tighter stop losses. That's the reverse of this learning. And we don't need to trade every day, but we need to observe the markets every day, because I feel that the daily observation of the market in terms of its open, high, low, close, and the general pattern of the charts, if we study them daily, creates a very valuable memory inside the brain as a trader to understand where the prices take support, where they seem to be hitting a resistance, and also the general behavior of futures after they have a correction, and you can see where they are getting support and trying to bounce back. Those kind of learnings are very valuable, and it doesn't happen in one day. It will take several months or maybe years for the good understanding of the futures to come, and that kind of understanding then creates enormous rewards because today when I see a daily chart or a weekly chart, instantly I can see where the support and resistances are and what we should be doing as our next trade. That kind of learning takes several years, but we need to watch the market every day, and that's what I do. And that learning and lessons are available through the service to everybody who is part of our group. So I hope you have gained something out of this first video that we have prepared. And to learn more about our E-mini futures trading signals and strategies, and also some bonus trades that we have on our website, you can visit our website, which is eminifutures.trading.biz. And you can also visit our performance page, which is eminifutures.trading.biz/performance. And here we will share our monthly performance data of the current year. And past performance data can also be seen, or you can ask for a report. We have a PDF file that we can send you by email. For any questions or comments, it's always welcome. Send us an email on info@eminifutures.trading.biz. And we look forward to hearing from you. It's a pleasure to interact with traders worldwide of all backgrounds, experiences, and if there's any way I can help you in doing your trades better, I'll be happy to do that. All the best. Thank you.